From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 12th, 2025. The baseball season is winding down. The Brewers will be home all week with the St. Louis Cardinals, followed by the Los Angeles Angels. All right, let's see what else is happening. Well, in West Dallas, there's the Dallas Farmers Market, one of the largest in the state, and also West Dallas has old-fashioned walking tours. Stay with me here. Yes, we're talking about the drink, Old Fashions.
Yes.
You'll check out the historic buildings and get 4 Old Fashions along the way. And you'll sample restaurants on the walk, which you'll need. Don't forget your commemorative glass. All right, stop the presses. A recent Yahoo government poll states that a full 78% of Americans couldn't give a rip about Travis Kelce and Taylor Swift. But the number changes dramatically. That number changes dramatically when you throw in 12-year-old girls into the mix. A man was arrested after driving through Prince George, British Columbia. Driving any motorized vehicle without a license on the highways of Canada is against the law, especially if you're driving a child's battery-powered pink Barbie Jeep. It's also illegal in British Columbia to pound so much alcohol that seems like a good idea. And finally, scientists have discovered that sexually aroused male flies are unable to sleep after close encounters with females, unless they only live for 20 days. There's very little time for foreplay. On the podcast today, we have Kendall Bauer, Tom Pappenfus, Joel Driesing, and we're wrapping up the week. Here's Kyle Tetting.
Well, thank you for that, Max. Good week overall for the markets. The S&P up 1.6%, closing at 6584. NASDAQ up 2.1%, closing at 22,154. And the Dow Jones Industrial Average up 1%, closing at the bell on Friday at 45,834. Despite losing 274 points on the day, the Dow was up 433 for the week. For the year, NASDAQ up 15.2%, including dividends. The S&P up 12.7%, and the Dow Jones Industrial Average up 8.7%. I think hard not to start the conversation, Tom, this week with just a look at ahead to what we are going to see next week, Tuesday, Wednesday, from the Fed. They'll start their September meeting on Tuesday. We'll get a formal announcement of interest rates on Wednesday. I think clear from all the data we've seen and all the conversation that everyone that's going to put their nickel down is putting it down on at least a 1/4 point cut. Some outsized chance that maybe the mega cut, the 0.5% cut, but it seems like where the inflation data was this week, that's not high on the list. I know you've been paying close attention to what some of the, JP Morgan's economist, David Kelly, talking about those rate cuts. What are you hearing about kind of what to expect as we look into kind of what the Fed's going to be doing next week?
Right. I think it's almost a foregone conclusion now that we're looking at a 1/4% rate cut priced in about 99% likelihood. The reality is I think the markets this week have largely priced that in. As you alluded to with, a report from Dr. David Kelly, just, kind of reminding people, the market, how a rate cut impacts stocks and us as stock investors. Lower interest rates can lead to higher multiples of valuations, just as a function of the math of earnings over price to earnings ratio. So, what he tried to do was just to say, for as great as that can be to leading to higher stock prices, we have to kind of look at this in full circle at the same time. The income part, there's an income effect from lower interest rates, meaning household income may be reduced by demand deposits that we may have. So we think of the trillions of dollars that may be on the sidelines right now. Based on JP Morgan estimates, they are estimating about $14 trillion in which are held in time deposits. So if we were to expect maybe a 1% cut in short-term interest rates, they anticipate that would be about a $140 billion decrease in interest income. Furthermore, you can look on the liability side of that. For people expecting, lower interest rates lead to perhaps lower mortgage rates, perhaps lower car or auto loan rates. They don't think that would be enough to offset, again, the reduction in income. Really only anticipating with a 1% interest rate cut that may only cut interest expenses on the household by about $30 billion, just due to the fact that a lot of those rates are locked in. They are longer term. And, kind of one of the other aspects they looked at also was just exchange rate effects. So, we kind of link up our declining rates to the softening dollar, which has, can be naturally a boost to exports, to trades, make our products more desirable to the global markets. But, of course, naturally, he kind of presents the idea that, 11% of GDP is really only due as a function of exports. So, so for all that there is great and the market likes it from the perspective of stock and market pricing, where we think markets may go, we do have to consider all these other factors that this could, the lower interest rates may kind of keep demand.
I think it is so interesting when you talk about that $14 trillion in demand deposits that are out there and how many of those are timed, right? It's a CD that's going to come due in 3 months, 6 months, a year. And I think if we do start to see the Federal Reserve more active in rate cutting, we may be entering an environment in which savers, not investors, but savers, people with money in savings accounts, checking accounts, and especially those demand deposits, the CDs, are going to have to start to rethink what's the purpose of these funds. Because 4.25% on a CD sounds great, but as the Federal Reserve begins to cut, you're probably going to see those rates start to come back down in line with what the Fed is doing. So you get a 1/4 point cut, and all of a sudden the next time you go to renew that 3-month or 6-month CD, maybe rates are a little bit less. And so in addition to all the things you're talking about, I think it may force some of those savers to start to think through what's the longer term purpose for these funds, because maybe there is a better place now to park cash than just leaving it in a CD or a bank deposit.
Yeah, exactly. I mean, I think you go back to our recent memory 10 years ago, any time frame beyond the last 6, 7, 8 years, and we had an overnight rate of around basically at zero. So what were we getting on CDs? Maybe 1%, 1.5%. So the natural function of that was people were more investing in the markets and leading to again further market gains. At some point there's going to be that trade-off where the interest rates on safe money gets low enough where people start to look at, how do I maintain my income, my yield, my growth potential, and again I think the natural second option would be to go back, and that could be markets.
Go ahead,
I think just to piggyback on that as well, it almost presents a little bit of a bullish case for the bond market in some regard, because remember the relationship, the basic relationship with bonds, when rates are going down, the value of your bonds are going up. So we could also see, and we have seen even over the past week, a shift in demand in the bond market, pushing bond returns higher, and the Fed likely to cut that lower end of the yield curve also looking like maybe a potential place of opportunity. Yes, a little more risk than something like a money market or a CD, but depending on what kind of part of the bond market you're looking at, maybe not as much risk as something like equities, although still pretty positive case for equities with rates coming down as well.
I think we've talked about this 1,000 times on this show, but a reminder that there is a place for cash, right? That for individuals who have a particular need coming up, who just want to see that money sit in an FDIC-insured deposit at the bank, that cash has its role. But again, these are the kinds of environments when we have to reevaluate what's the right number, what's the right place, and what's the right kind of step for that doesn't belong in the shorter-term thinking. And of course, if we do see those rate cuts, there was some hope, Kendall, that potentially the housing market might see some benefit from falling mortgage rates. I think the conversation there is probably a little bit bigger now than just strictly what mortgage rates look like.
Yeah, good article in the Wall Street Journal this week about mortgage rates at or near an 11-month low. It's interesting because this idea that rates coming down may help fix the housing market, and I think it's just a little more complicated than that. Rates could come down, mortgage rates could come down, but affordability is still tight. Home prices roughly 50%, maybe check me on that, higher than they were in 2019. Demand picking back up, likely to put a pressure, an upward pressure on price as well. And then the potential of a weakening job market now starting to offset maybe that ease that you would see from rates coming down. So And that doesn't even mention the shortage of supply that we've been talking about for years. So I think housing's still very complex. I think it may be exciting for those that are sitting on the sidelines, hoping to see rates fall below 6%, is that's often kind of an entry point for a lot of people in the back of their head. But I don't think the housing market and the issues there are going to just.
And Kendall, you mentioned the job market, and that's something that enters into the psychology of a lot of wannabe home buyers is, is my job stable? Is it going to be around? We got news this week. It was a revision of data that the Bureau of Labor Statistics has been collecting on employment, and it showed that in the 12 months ended in March, that we actually had nearly 1 million jobs fewer than we thought we had. So we got a report last week that we actually lost jobs on a net basis in June. That was the first time we had a reduction since the end of 2020. But now we're hearing that the job growth that we were seeing all along wasn't as robust as it seemed. We still were increasing the number of jobs, in our economy, but they haven't been as great as we thought.
I think there's two really important things to point out in that revision. The first is that it is a fairly typical process that the Bureau of Labor Statistics undertakes to ensure that the data they are capturing historically lines up with the actual environment. And that is a really tough thing to do month to month, quarter to quarter, but with some hindsight, you can start to normalize what that looks like. Certainly this is a bigger revision, but it is in line with what the Bureau is tasked with doing, which is to ensure that the data they're reporting is accurate. The other piece that I think is worth pointing out, though, is that it's not as if we suddenly told 1 million people, well, you thought you were working last year, but it turns out you weren't. It's just that we hadn't measured the number perfectly. And so the other economic data, consumer spending that we were reporting last year, the GDP data, all of that is still valid. It's not as if suddenly we took away all that money those people made last year. And so I think it's important to point out that we want to make sure the data is right. We want to make sure that we are not just using bad data because that's what we said 6 months ago. If we know it's different, we should change it.
We want good data. And we've been hearing from the Fed for months, for years, that what they do with these interest rates is data-driven. So if we're telling the Fed, hey, you know what, our job market isn't as strong as we thought it was, they're going to have to be more careful with raising interest rates. And the reason, at lowering interest rates, and one of the reasons, the main reason that they're looking at lowering interest rates again is because of how weak jobs are. But we also got news this week on inflation, which is the other part of their dual mandate. And inflation was the highest it's been in 7 months. It's back up to 2.9% year to year. That's the consumer price index. Now remember, it was 9.1% just 3 years ago. And then the Fed raised interest rates so that the price increases would go down, and they got it down to 2.9. Actually, they got it down to 2.3% in April. And that's closer to their long-term goal of having 2% inflation, but now it's starting to creep back up again. And so they have to walk this tightrope between, taking care of jobs and taking care of prices.
And it is a tightrope, and it changes day to day sometimes, right? That the maybe expectation prior to the inflation announcement this week was maybe we will get a 2/4 point or a 0.5% cut, and then it was pretty quickly shifting back to, well, all right, the labor market is certainly softer than we thought. It's worth a cut, but maybe it's not quite worth that mega cut that we were talking about. And of course, I think part of the challenge, Joel, is that we don't see the impact of those rate cuts immediately, that it takes time for the market to digest some of that change.
We were talking about mortgage rates. I looked this up. So when the Fed started raising interest rates in 2022, that was around March or so, the mortgage interest rate was then around 4%, and it finally peaked at 7.8% in November of 2023. So it started raising rates to lower the interest rate. And as far as its relationship with mortgage rates kept going up for a year and a half after they started trying to control inflation. Another point is I was reading from an economist today who was pointing out that interest rates have a closer and more direct relationship with inflation and price increases than it does with job creation. And if they're lowering rates now to help the job market, that's something that's there's a lot of things that go into whether or not businesses hire or fire workers. And interest rates is just one of them. So we shouldn't expect, as far as the labor market aspects of this, we shouldn't expect great things. And to your point, Kyle, not real quickly.
You know, I think maybe one of the biggest influencers of whether or not you're willing to take on more payroll, willing to take on more capital expenditure or projects and just stimulate the economy overall is how certain are you about the economic future? And in points in time in which things are quickly shifting, in which perhaps we are at the mercy of, just changing winds in general, I think it can be a little more unnerving to business leaders to say, well, yeah, I'm going to staff up right now. Because if you don't know what your costs are going to be, if you don't know, for example, what trade policy is going to look like, which is a big one right now, it isn't necessarily that the policy is better or worse. It's that you just don't know what to do. And so I think as a business owner, you might be more apt to sit on your hands or maybe choose the path that is, well, the more conservative choice right now. Joel, beyond employment data, we got, and in inflation data, we got a consumer sentiment number this week. And we look so closely at it. It's so important, the state of the consumer in our country. Certainly, sentiment and confidence are a big piece of that, but also just the ability for the consumer to maintain kind of their ability to pay overall is important.
And that's where some of that uncertainty also plays a role. We got preliminary numbers for September from the University of Michigan on its consumer sentiment index, and it's down 5% from August. It's down 21% from a year ago. It's still above where it was in April and May, right after the government said, hey, we're changing all these trade policies. So that sowed a lot of uncertainty into the lives of people, because they were all hearing that, hey, these tariffs are going to cause inflation and prices are going to go up, and my family's not going to be able to afford that. And that's still out there. There's still that uncertainty over tariffs and what that's going to do to inflation, and consumers are registering that as a concern and something that's making them less confident in their spending.
And rightfully so. And, certainly we can see positive resolution, we can see clarity, and all of those lead potentially to either improved confidence or willingness to spend. And so I think that's kind of the hope is as we continue to progress that we get that clarity. One of the big stories this week, Tom, was just the outsized spending that was taking place in artificial intelligence. You had Larry Ellison overtake as kind of the world's wealthiest individual as Oracle saw a big bump this week. But I think there's a bigger story at play here with respect to kind of how we choose to invest, and that is that for so many years we were told indexing was the best possible way to dive into investments. It's cheap, it's broad exposure, and I think some interesting comments this week from one of the investment leaders at Capital Group, the parent company for American funds, just talking about some of the ways that focusing on just strictly index can go wrong.
Yeah, I think we all can agree. We all rooted and we're very happy for Larry Ellison to achieve that new level of wealth. I'm sure we'll all get there pretty soon. But
if you're listening, Larry Ellison.
Yeah, thanks. He's a well-known listener. Yeah, I mean, I think, what we've seen this year, and certainly my reviews with clients is, I think clients' portfolios are having a really nice year. And, we've always been proponents of a lot, considering, favoring might be a strong word, but we've definitely have been, had a bias towards active management. Because they take into consideration risk, and our goal, as we always tell people, is try to attain the best risk-adjusted returns for you so that you can sleep a little bit better at night. But yeah, there is some study that was done, and take it with a bit of grain of salt because done by Rob Arnott, who's a fund manager and has his own agenda to push. But They're coming out with a paper here, just kind of looking at the narrative, of how index investing really works. Just because, as people may or may not know, an index is not always the same amount, same companies year over year. They do go through a period in which they change names just because of the qualifications you need to have to be into that index. And based on kind of what they were studying is that they've seen a lot of change happen every year. Usually about 5% of an index will change over in any given year. So that means some companies that have grown large enough will get in, and some companies that have underperformed, have become smaller, will leave. You might imagine, though, that how do you qualify that, or how you become larger, is by share price. So what kind of qualifies you is all this past performance to get into the index. And what the studies have kind of found is that this past performance led them to become part of the index, but after that, their performance has lagged their peers and counterparts. And then at some point, they found over the last 30 years that on average, about 25% of the companies have been moved in and out of the index in a 10-year time span. So it does mean that also once they move out, they can move back in. So they've found a lot of turnover in this small segment of an index. And ultimately, when some of these companies first get in there, if they don't have or can't carry that momentum, it does lead to a lot of underperformance. And they've equated it to about 0.7% and kind of lost performance by some just the nature of the qualifications to get into the index and kind of the limitations that provides. So I think they're kind of largely making a case that, well, ultimately I found at the end of the article that they're trying to promote an index fund that they have, but that has qualifications so that there is less turnover. It doesn't, it's a lot more difficult to get in and ultimately to be kicked out of the index. But I think, the heart of it, what I took away is just that indexes aren't everything. There are certainly some benefits to low-cost investing, definitely, and leading to getting better returns. But as we're seeing this year, and I always kind of tell clients, as we see more challenging years, perhaps years where markets are down or sideways, a lot of market breadth, a manager and a team of analysts can go a long way in adding to returns. And this is certainly a year where we're seeing that in client accounts. So, it's something to pay attention to.
I think another, side point to what you're talking about with regards to indexing versus active management, I think, and we agree on this as a firm, I would say that there's a place for both. In fact, they both have, positives and benefits to a portfolio. But indexing, for example, the S&P now isn't, and this is going to sound like an obvious statement, it's not the S&P it was 15 years ago. With the introduction of these mega cap companies, Magnificent Seven, and their weight alone in the index adds more risk than maybe what the composition of something like the S&P looked like 10 years ago. Those 7 companies accounting for some astronomical portion of the index with 30 or 40%. NVIDIA alone bigger than segments like healthcare and materials. And Kyle, jump in if I'm saying the wrong ones. But the point just being that this idea of indexing being low cost, set it, forget it, it's not that simple anymore with the way the market has shifted and some of these juggernaut companies. So,
yeah, Kendall, 10 names in the S&P accounting for around 40% of the index, depending on what day you look. It is clear that it is not what it used to be. That number has grown so substantially. The percentage of those 10 names that is the S&P has grown so substantially in the last few years that, really you could buy 10 or 15 stocks and get the bulk of the expectation you're getting from the S&P. Not that that's the right approach, because ultimately it's more, Tom, to your very first point, it's more about how you manage risk. And I think when we look at these tools, what we're trying to do is figure out, how do we build something? How do we construct something in a way that best capitalizes on the opportunity that each of these tools provides, right? They all serve their purpose. They all have their role. And how do we make sure that they fit with what we're trying to do for clients? And so, again, at the end of the day, I think you want to buy funds, you want to buy investments, you want to buy whatever that you understand, first and foremost. You know what it is you own, why you own it, but that second of all fits what you're trying to do. And that is not as simple as just buy this one thing and don't ever have to think about it again. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.